The bullish side for both gold and silver is we've had this beautiful bull run. Now we've got it building this multi-wave, this bull flag pattern, which can be seen as a very strong pattern. If gold starts to break out and builds a base, it will generate another buy signal at some point here. And then we're off to the races to 7,000, 8,000, 10,000.
Many people get attracted in a positive sense to a hyperbolic up move. I get attracted in a negative sense to a hyperbolic up move. I decided specifically that since the reason I owned my silver went away, that there were better speculations for me than silver. So I exited silver for other uses of capital. I did not exit gold. In fact, 20% of the money I made, 25% of the money I made selling my silver stocks, my physical silver, I used to buy physical gold.
Gold futures delivered their strongest single-session performance of April on Tuesday, surging nearly $100 as markets reassessed the likely trajectory of the Iran-US standoff in the Strait of Hormuz. The advance marks the highest closing price for gold in nearly 30 days, erasing the prior session's losses and then some, and firmly reestablishing the metal's upward momentum. Market specialists and financial analyzers Chris Vermeulen and rickrule offer a well-rounded view of today's financial landscape. In this video, Chris Vermeulen explains that recent market behavior reflects a clear shift in capital flows, with both retail and institutional money rotating into risk-on assets like equities. However, he suggests that precious metals still have short-term upside potential, especially if market fear returns, while equities may be nearing a pause after a strong rally. In his assessment, Vermeulen further notes that gold and silver have gone through a euphoric phase, followed by a sharp correction, leaving many investors uncertain and shaken out of positions. This could either lead to a deeper correction, potentially bringing gold toward lower levels like $3,500 and silver near $40, or form a strong base for the next major rally. Based on fundamentals, Chris Vermeulen believes that once the market stabilizes, gold and silver could enter a powerful bullish phase again, potentially reaching much higher levels in the coming years. In his view, whether through a correction or breakout, the long-term trajectory for precious metals remains strongly positive. If you're ready for unfiltered truth and sharp market analysis, hit that subscribe button. Let's explore the latest insights from Chris Vermeulen and rickrule's recent interview.
I would say the stock market's ready for a little bit of a pause. It is at resistance. But overall, I mean, semiconductors, I think, are overbought. If semiconductors pull back, it also probably means the broad market is going to pull back at this point. I think there's some spots where there is some upside potential. So I think equities, they've had a nice move. I mean, we just locked in partial profits here to reduce our exposure. I think where there is some upside is actually going to be, I think, precious metals. I think gold has got a really nice chart pattern. If we see a little bit of fear in the market, I think gold might come back to life and push up to 5,000 or a little bit deeper, 5,100 or so. I think gold's got a very short-term trade opportunity to the upside, because I think it can move with the equities market if it goes higher. But also, I think if we have a little bit more fear, a little more bad news, I think gold will actually maybe start to shine a little bit here and move higher on the weakness when equities pull back. Gold and silver were performing kind of as they should and normally do. If we zoom back on the chart, we've been seeing them perform very well up until midway through last year. And then we got into this big consolidation, this big consolidation through most of last year. And then we saw this huge euphoric phase. And this really got everybody like overly excited. Everything's going to the moon. There's no stopping it now. That's where everybody piled in. And then we had this huge correction, which silver got hit even harder. I think this correction really hit a lot of precious metal traders hard. This is like, getting punched in the face. I think everybody in the precious metal space is still kind of wondering what happened. How did they not lock in profits, and how much they've seen things pull back and correct? And is this a top? And so I think we're naturally just seeing investors not knowing what to do when it comes to precious metals, and their money's just moving in and out and moving with the equities market at this point. But I do think it's almost been long enough that we're going to start to see precious metals start to work a little bit more like a defensive play, where I think they could move higher while equities trade sideways or pull back. But we haven't really seen that quite yet. If we look at the silver volume, if we take a look at silver, we can see here volume dramatically different. You can see how this huge pullback created a ton of fear, and now there's very light volume. It's just people don't know what to do. They've given up on it. They're like, oh, I bought at the peak or whatever it was, and they're like, I'm just I'm just going to not trade it anymore. I'm just going to leave it. So this is a good thing. The market is trying to shake people out. And then if it doesn't shake you out, it will generally wait you out. And so silver and things that trade sideways, they go sideways sometimes until there isn't any interest, until people give up, and then it'll start to move. So again, I think we're just waiting to see how investors are going to react, and for metals to come back to how they used to trade. And I think we're getting closer. There's starting to be enough time in here that people are kind of licking their wounds, realizing that, hey, this is just a typical pullback in silver and gold in that type of market environment. We had this euphoric phase, which is what I was screaming. I mean, we exited out of silver at 113 when everything was screaming, and that was the full-on euphoric phase. And now it's pulled back, and now it is trying to figure out what it wants to do. And that's the big question: is what is silver going to do? Is it going to correct and go lower based on Fibonacci extensions? It says we're going to $40 per ounce for silver, which will come right back down to this breakout where the euphoric phase took off. The gold chart is doing the same thing. The gold chart shows, based on Fibonacci, the downside move brings it right back to 3,500, which is gold was functioning normal up until this point. And then suddenly it became all the craze, the euphoric phase. And so the chart is actually pointing to gold coming all the way back down to this point as well. To me, this is going to be an amazing opportunity. I mean, so a lot of people don't want this, but to me, I want to see the stock market pull back. I want to see gold come down to 3,500. I want to see silver crash to 40 or $38. It is going to be an ultimate opportunity. And the market has a way of, whoever chased price, when people are all chasing price and driving it up and it's like an emotional move, the market has a good way of shaking them all out, getting them back out, and then they end up taking a loss on it. And then I think we see things stabilize. And then I think gold and silver will be a great opportunity. So I think people should be gunning for 3,500 for gold, 40 for silver, because it's going to be probably the last opportunity to get back into those metals at a crazy good discount. And I think in the next, 5 years from now, we're going to probably see gold and silver up hundreds of percent from here. So the question is, how long is it going to take for gold and silver to correct? That's the big question. And we just have to wait. The flip side of that, David, I know people are going to ask, well, that's the bearish side. The bullish side for both gold and silver is we've had this beautiful bull run. Now we've got it building this multi-wave, this bull flag pattern, which can be seen as a very strong pattern. If gold starts to break out and builds a base, it will generate another buy signal at some point here. And then we're off to the races to 7,000, 8,000, 10,000. Yeah, there's several things. Like our strategy follows about 8 different types of money flows to various pockets of the markets and different currencies, different asset classes. And so we have seen a shift. We have seen a shift of people moving away from some defensive spaces. We're seeing people move into the risk on. So we are definitely seeing, it's not just small traders, it is big institutions. Big money has been flowing and moving the needle in terms of they've been getting positioned for a move higher for, the past week and a half or so. And we've seen that on our charts. But again, I use like a proprietary mix of combinations of what I do in order to track what's going on here. So, I mean, the fact that we've been seeing recently, gold's not really performing much of a safe haven play. It seems to just sell off with the equities markets. I think precious metals, they have a little short-term bullish price action. I think we could see this move a little bit higher. But right now, the big money flows are definitely moving into growth stocks. And we're seeing that even if we look at our hot list over here, we've got SMH. This is top of our hot list. It is outperforming everything else. And our strategy kind of shows, this red bar across the bottom. There's a time when you don't want to own stocks. And then there's a time when you want to get in own stocks because they're going to be favorable. And I like semiconductors simply because it's a lot like, gold miners. If you ever watch the show, Gold Rush, although I haven't watched it in a long time, but it's the same thing. The gold miners take all the risks. They put on all the work. A lot of them don't make any money. The people who make money are the people who fix the machines, supply the fuel, provide all the repair parts and replacement parts. Semiconductors are like that, right? A lot of AI companies are just bleeding money, borrowing and spending and borrowing and spending. But then you get the semiconductors here. They're just supplying these companies that are taking all the risk and all the gamble. And so semiconductors are just screaming higher. I think we've got the movement in AI is still very strong. I think it's shifting a little bit away from maybe some of the specific AI companies and focusing more on the actual companies supplying the materials, the mechanics of the thing.
Discussing his current strategy, Rickrule prefers holding high liquidity and gold for stability rather than chasing undervalued mining stocks, emphasizing that protecting capital and staying prepared matters more than maximizing short-term gains. Recent market news supports this cautious approach, as gold remains highly volatile, rising above $4,800 on safe haven demand amid geopolitical tensions, but also experiencing sharp pullbacks due to a stronger dollar and shifting rate expectations. Despite this volatility, strong central bank buying and continued global demand are keeping the long-term outlook bullish, reinforcing the importance of holding liquidity and real assets like gold. Regarding current market conditions, Rickrule says that although junior and mid-tier gold companies appear undervalued, he is prioritizing liquidity over new investments due to rising risks in the financial system. He mentions that while gold may perform well, caution is necessary given potential instability in credit markets. He explains that lessons from the 2008 financial crisis have shaped his strategy, emphasizing the importance of holding cash during uncertain times. While not predicting a crisis, he warns that stress in areas like private credit and high-yield ETFs could create liquidity issues, making it crucial to stay prepared for future opportunities. Let's jump into the interview.
I don't. I think the smaller end of the gold sector is cheap.
Okay.
It's just I don't care what I think. I want to sleep nights and stay calm.
I see.
I have what is, in a historical context, too much liquidity in my portfolio. A financial planner, or frankly, a Rickrule looking at my portfolio 2 years ago, would have said you have too much liquidity. You have a lazy balance sheet. Right now, lazy feels just right. I increased my gold holdings because gold functions for me as liquidity. It's a savings asset. Silver occupied a speculative place in my portfolio. I bought silver originally because silver was hated. When it ceased to be hated, the reason to own it in my account went away. So I had to say, what's the best use of speculative cash? The decision was made easier for me because there was a hyperbolic up move in silver, what you Canadians call a hockey stick graph. I've learned that the backside of a hockey stick graph is just as steep as the front side, but it's a lot less fun if you happen to be long. And so while many people get attracted in a positive sense to a hyperbolic up move, I get attracted in a negative sense to a hyperbolic up move. I decided specifically that since the reason I owned my silver went away, that there were better speculations for me than silver. So I exited silver for other uses of capital. I did not exit gold. In fact, 20% of the money I made, 25% of the money I made selling my silver stocks, my physical silver, I used to buy physical gold. What I want to be doing is buying the single asset and mid-tier gold producers, because I think that the market is underpricing them relative to the seniors. I think the gold price will do well. I think that either those companies will re-rate or the big ones will take over the little ones, but that's not what I'm doing. I'm building cash. I have seen markets before where there's a crisis of confidence, where there's a liquidity squeeze. I'm not saying this is going to occur. I'm not even going to say it's a probability, but it's a strong enough possibility, and the penalty for failure is high enough that I'm building liquidity. The last time I saw concern about credit become a contagion was 2008. And I watched in a fairly short period of time equities markets lose half of their price support. The consequence of going into 2008 well capitalized and also well educated was that 2009 was the single best investment year of my career, percentage-wise. During periods when other people don't have liquidity, having liquidity is what means that you take advantage of the circumstance as opposed to being taken advantage of. Now, the point you make is very valid. I'm getting paid something like 4% on my liquidity in a currency where I believe I'm losing 8% of my purchasing power, which is to say, arithmetically, I'm not making 4%, I'm losing 8%, or pardon me, losing 4%. I regard the 4% that I'm losing in real yield as being an option payment, an option premium, to preserve my liquidity in case that liquidity comes in handy. The circumstance that you're seeing now in credit is challenging in many ways. I see the private credit conundrum as being partially the fault of very poor underwriting, and I see that in the commercial banks too. But I also see it in rising interest rates, which limits the availability and increases the price of credit, which makes credit less financeable. To the extent that credit concerns go beyond folks like me, to mas and pas, savers, that becomes problematic. In particular, David, and this is obscure, but you need to hear about it, there's a huge proliferation of products in the United States and Canada, high-yield ETFs, exchange-traded funds that invest in, for want of a better phrase, junk bonds. And they're owned by people who I inelegantly term yield whores, ma and pa investors who are chasing 150 or 200 extra basis points in yield with no knowledge of the credit risks that they're running. These ETFs are extremely liquid. There's trillions of dollars in AUM, and they trade billions of dollars a day. The difficulty is that the underlying assets that they own, over-the-counter bonds, high-yield bonds, are extremely illiquid. And if you have disintermediation, if the mas and pas that own these ETFs go to redeem them, the managers who run the ETFs may be unable to sell the bonds that would fund the redemptions. There you would get a run on the bank with no FDIC. I'm not saying this is going to occur, but it causes me a lot of concern. In that regard, it reminds me of nothing so much as the air in the CDO market before the 2008 real estate credit collapse. Repeat again, I'm not forecasting a credit collapse. I'm just saying that the possibility of it is high enough and the penalty for failure of it is high enough that I personally am building liquidity, despite the fact that in a real sense, that liquidity is costing me real yield.
The recent correction in gold and silver, rather than signaling weakness, appears to be part of a broader consolidation phase that could reset the market for the next major move. Recent market developments reinforce this outlook, as gold continues to attract strong central bank demand, especially from countries like China, while geopolitical tensions and fiscal concerns support its role as a safe haven asset. Despite short-term fluctuations driven by interest rate expectations and dollar strength, institutional forecasts remain increasingly bullish, with some projections targeting $6,000 in the medium term and even higher levels in more extreme monetary scenarios. At the same time, growing stress in private credit, rising global debt, and liquidity mismatches in financial products are adding to systemic risk. This echoes concerns seen during past crises, like the 2008 financial crisis. In this context, gold is not just a hedge, but a potential cornerstone asset in a shifting financial system. The current combination of technical setups and macroeconomic pressures suggests that gold and silver could play a much larger role in portfolios over the coming years. As global debt rises and financial risks continue to build, will gold simply remain a hedge, or is it on the path to becoming the foundation of the next monetary system? Let us know what you think in the comments. If this video brought you any knowledge, give it a like, subscribe, and ring that bell so you're always in the loop. See you in the next video.